studying your last two. I swim med when turned in. The styrene down to mute. And can learn the pole that sunk he died.
When studying Canadian dividends, one of the first questions students ask is, why are there two types of dividends? The answer lies in the amount of corporate tax that was paid before the profits were distributed to shareholders. Let's start with the basic idea. A corporation earns income and pays corporate income tax on that income. However, not every corporation pays tax at the same rate. Some corporations, particularly large corporations, pay tax at the general corporate tax rate. Others, especially Canadian-controlled private corporations that qualify for the small business deduction, pay tax at a lower corporate tax rate. Because different amounts of corporate tax have already been paid, Canada's tax system uses two different types of dividends to help achieve tax integration. The goal of tax integration is to ensure that the total tax paid first by the corporation and then by the shareholder is reasonably balanced, regardless of how the income is earned. When corporate income has already been taxed at the higher corporate tax rate, the corporation can generally pay an eligible dividend. Since more corporate tax has already been paid, the shareholder receives a larger dividend tax credit when reporting that dividend on their personal tax return. This helps reduce the amount of personal tax payable. On the other hand, when corporate income has been taxed at the lower corporate tax rate, such as income eligible for the small business deduction, the corporation generally pays a non-eligible dividend. Because less corporate tax was paid initially, the shareholder receives a smaller dividend tax credit, resulting in somewhat higher personal tax than would apply to an eligible dividend. The important point is that the shareholder does not choose whether a dividend is eligible or non-eligible. The dividend type is determined by how the corporation's income was taxed before the dividend was paid. A simple way to remember this is to follow the money. The corporation earns income, pays corporate tax, determines whether that income belongs to the eligible or non-eligible dividend pool, and then distributes the dividend to the shareholder. The corporate tax paid first determines the dividend type, and the dividend type determines the amount of dividend tax credit available to the shareholder. The key takeaway is that eligible and non-eligible dividends exist because corporations do not all pay the same corporate tax rate. Eligible dividends generally come from income taxed at higher corporate rates and provide a larger dividend tax credit, while non-eligible dividends usually come from income taxed at lower corporate rates and provide a smaller dividend tax credit. This system helps maintain fairness by supporting Canada's principle of tax integration. To understand eligible and non-eligible dividends, it's helpful to follow the complete journey of corporate income from the moment it is earned by the corporation until it is taxed in the hands of the shareholder. This process illustrates how Canada's tax system attempts to achieve tax integration, meaning that income earned through a corporation should, as much as possible, be taxed similarly to income earned directly by an individual. The process begins when the corporation earns business income. Before any money can be distributed to shareholders, the corporation must first pay corporate income tax. At this stage, the applicable corporate tax rate becomes very important because it determines which type of dividend the corporation can generally pay later. If the income was taxed at the higher general corporate tax rate, the corporation may designate the payment as an eligible dividend. Since the corporation has already paid more tax, the shareholder receives a larger dividend tax credit when reporting that dividend on their personal income tax return. This larger credit helps offset some of the personal tax that would otherwise be payable. On the other hand, if the income benefited from the lower small business corporate tax rate, the corporation generally pays a non-eligible dividend. Because less corporate tax was paid at the corporate level, the shareholder receives a smaller dividend tax credit, resulting in somewhat higher personal tax compared with an eligible dividend. Once the corporation determines the appropriate dividend type, the board of directors formally declares the dividend and pays it to the shareholder. The shareholder then reports the dividend on their personal tax return. Canadian tax law requires the dividend to be grossed up, which estimates the corporation's pre-tax income before applying the appropriate dividend tax credit. This sequence of gross up followed by the dividend tax credit is what helps integrate corporate and personal taxation. It is important to remember that both eligible and non-eligible dividends are taxable. The difference is not whether tax is paid, but how much corporate tax has already been paid before the dividend reaches the shareholder. The dividend tax credit adjusts for that difference so that the overall tax burden is more balanced. The key takeaway is that the dividend process always follows the same general path. The corporation earns income, pays corporate tax, determines whether the dividend is eligible or non-eligible, distributes the dividend to the shareholder, and finally, the shareholder reports the dividend and claims the appropriate dividend tax credit. The higher the corporate tax paid initially, the larger the dividend tax credit available later, helping Canada maintain its principle of tax integration. Eligible and non-eligible dividends both represent distributions of corporate profits, but they are not taxed in the same way. The reason for this difference is simple. The corporation may have paid different amounts of corporate income tax before distributing those profits to its shareholders. Let's begin with an eligible dividend. Eligible dividends generally come from income that has already been taxed at the higher general corporate tax rate, since the corporation has already paid more tax. The shareholder is rewarded with a larger dividend tax credit when reporting the dividend on their personal tax return. This larger credit helps reduce the shareholder's personal tax and supports the goal of tax integration. Eligible dividends are commonly paid by large public corporations and by private corporations on income that does not qualify for the small business deduction. Now consider a non-eligible dividend. These dividends are usually paid from income that benefited from the lower small business corporate tax rate. Because the corporation paid less tax initially, the shareholder receives a smaller dividend tax credit. As a result, the shareholder generally pays more personal tax on a non-eligible dividend than on an eligible dividend of the same amount. Non-eligible dividends are therefore very common among Canadian-controlled private corporations that qualify for the small business deduction. If we compare the two side by side, the differences become much clearer. Eligible dividends are linked to higher corporate taxes and provide a larger dividend tax credit, while non-eligible dividends are linked to lower corporate taxes and provide a smaller dividend tax credit. Although both dividends are taxable, the amount of personal tax ultimately paid by the shareholder is different because the dividend tax credit has been adjusted to reflect the corporate tax already paid. A helpful way to visualize this is to follow the corporate tax journey. First, the corporation earns income. Next, it pays corporate income tax. If the corporation paid tax at the higher general rate, it can generally pay an eligible dividend, which leads to a larger dividend tax credit for the shareholder. If the corporation paid tax at the lower small business rate, it generally pays a non-eligible dividend, resulting in a smaller dividend tax credit. The important point is that the shareholder does not decide which type of dividend they receive. The corporation determines the dividend type based on how the underlying income was taxed. Once the dividend is designated as eligible or non-eligible, the shareholder reports it accordingly on their personal tax return. The key takeaway is that both eligible and non-eligible dividends are taxable distributions of corporate profits, but they exist to reflect different levels of corporate tax already paid. Eligible dividends usually result in lower personal tax, because they come from income taxed at higher corporate rates, while non-eligible dividends generally result in higher personal tax because they come from income taxed at lower corporate rates. Together, these rules help Canada achieve tax integration by balancing corporate and personal taxation.